Hey everyone, and welcome back to the Velocity channel, where this is your bridge to financial freedom. Today, we want to go into 5 advanced velocity banking strategies. All right, now before we do that, go ahead and if you haven't checked out my previous video on mastering velocity banking step by step for beginners, go ahead and check that one out. But we're going to go ahead and run this back. 5 advanced velocity banking strategies we've never ran over before, so you're going to want to pay attention to this. Before we get into it, like, share, and subscribe. Let's get into it right now. All right, now, of course, we're going to be using examples on the whiteboard of what we're talking about so that you have a clearer picture of what to do in your situation. You can implement them today, all right? Strategy number 1 is use multiple lines of credit. The reason why you want to do this can help you pay off multiple loans all at once, all right? This is why you want multiple lines of credit. Now, 3 to 5 credit cards is the maximum. I'm just going to go with what my mentor, Garrett Gunderson, says. Big shout out to him, my goodness, and also Optimum Wealth, all right? Listen, multiple lines of credit can help you in tremendous ways. Now, 3 to 5 credit cards, that's on the personal credit side, all right? Those of you who know about business credit, sky's the limit. You don't have to have the 3 to 5, right? You can have the 3 to 500. You know what I mean? Goodness. How many credit cards? That depends upon you, right? Because on the business line of credit side, you know what they think about? Can you pay each and every month? So let's go ahead and give you a scenario of those multiple lines of credit in action right now. I want to break this down, if you would just allow me to think just a little bit, because I want to break it down first grade level. All right, absolutely. Let's do this. 3 different loans. One for 10K, okay. One for 5K, and then another one for 7K. Right? It's going to be at 8%. Okay. This one's going to be at 12. Let's do this one at 12%. 12%. And then this one is going to be at 10%. Right? And the terms are going to be 2 years here, 1 year here, and then 3 years there. We want to show you through the consolidation, right, of the lines of credit. Remember, we already did a video on that, but we're going to show you the power of multiple lines of credit right here and right now. All right. So now we got to go forth and get some lines of credit. So say we got one at 15,000, right? So let's go ahead and draw a border here. So we got one at 15,000. I'm going to clean this up for y'all, right? And then another one at 7,000. All right, let me go ahead and clean this up. Now, you probably already know what I'm going to do at this point, because I like utilizing or controlling the things that I can control. I can't control when I put my money towards a loan, which is one way, right? In English, right, they taught me that one means A, right? So when you say one way payment, right, that's a way, and that's a way for me. So I don't want that, right? What I do want is revolving line of credit, something I can pay, borrow, pay, borrow, pay, borrow. So let's look at it. Loan A, $10,000 at 8% for 2 years. Loan B, $5,000 at 12% for 1 year. And then loan C is $7,000 at 10% for 3 years. Can you guess what I'm going to do? $15,000 at 6%, which is line X, right? That's your first line of credit. Then your second line of credit, remember those are multiple lines of credit. Line Y, right? $7,000 at 7%. What would you do? Now, I know what I would do. Let's go ahead and take this $15,000 and wipe out both loan B and loan A. Now, why is that? Why would I wipe them out? Because many times loans are going to be calculated differently than lines. Let me say that again. Loans are many times calculated differently than lines. Plus, right, if you didn't agree with that, You cannot pay, borrow, pay, borrow, pay, borrow from a loan. You can only pay. Remember that one-way payment. But with the line of credit, what you're doing is you're essentially going to be using your line of credit as your new checking account, because that $5,000, that $6,000, that $10,000 that comes in each month, right? You can then pay the expenses from the same account. That's why I say it's a new checking account, right? And let's say you have $1,000 left in there. Let's say you have $2,000 left in there. Guess what? That $2,000, that difference between the income and the expenses, that's what's paying the line of credit off, all right? And that's why we do it. So let's go ahead and get rid of loan A and loan B. You know me, I got to go ahead and get rid of loan C as well, because I want to do a full transfer from the line of credit from the loans, right, to my lines of credit, because I want to be able to control my money. With the loans, you can't do that. It goes straight to the lender. The lender says, thank you. How many of your lenders have actually said thank you? Mine neither, but I do appreciate them. All right. We definitely have no problem with financing. God bless. Let's go ahead and take you to the another step. Now we're going to go ahead and finish this off and let you know that these loans have been converted. Right? They've been converted from scheduled, from away from you to revolving lines of credit. So now you still got debt, but it's debt you can control. It's $15,000 at 6% and $7,000 at 7%. All right, so step number two, prioritize high interest loans, or do we? All right, so let's go ahead and get into our example right now. You see the example of $5,000 at 20% and then $5,000 at 5%. Each of these is going to tell you about the annual percentage on that interest rate. It's going to be $1,000, right, in money terms. So this is the amount of dollars that you're going to spend if you kept the $5,000 for that year, at 20%. Then $250 at 5% for the $5,000 balance on that one, Now, since we are talking about loans, how many of you know that you got to read the fine print, because the big print giveth and the small print taketh away? On this illustration, it's going to be very simple in simple terms, but I want to show you what the power of making sure that you're utilizing the cash flow index correctly is. Now watch this. Say it's $83 each month, on the $5,000 at 20%. And then on the next one, you have the $20 a month. Now, of course, you would probably prioritize the high interest one, wouldn't you? Now, what if the minimum payment looked like this? Even though, $250 you're going to spend for the year because it's at 5%, it's lower, than the 20%. That's what we were taught in school. Which one would you pay off now? That's right. The one that is sucking the most cash flow from you relative to your balance. That's what it's all about. We don't want cash flow sucking loans. We don't want cash flow sucking interest rates. We don't want cash flow sucking lines of credit. We want that cash flow sucker gone. All right. So, of course, between these two, you're going to pick the one that's cash flow sucking, which is the one that has the cash flow index number of 50 versus the cash flow index number of 60. And that's what we will look at versus just the interest rates. We don't want to be just looking at just the interest rates. We want to also be looking at what is the number when we divide the loan balance by the minimum monthly payment. The lowest number is the ineffective loan that we have to eliminate, and we got to eliminate now. On to the next step. All right, step number three, strategy number three, you're going to use a credit card for daily expenses, right? Why do we want to do that? This can help leverage the grace period and reduce the interest on your line of credit. Now, I do want you to know that there is a difference between paying at the statement date and paying at the due date. At the due date, you're taking advantage of that grace period. It should be like 20, 25 days, something like that. Of course, go ahead and get with your card producer on that. And we are working on a card, right, that is going to be revolutionary. So we're working on that right now. Please keep in touch with us. Get on our newsletter so you stay updated with that. But I want you to know something. That average daily interest that you're getting charged, with the example of the $5,000 at 20%, that's $1,000, right? $5,000 at 20%, $1,000 in interest, which will be charged for that year if you kept that balance. If we divide that, if we reduce it down to the ridiculous, right? That's about $3 a day. It's $2.77 each day. And so when you're paying on your statement date, right, do you have to worry about the grace period? When you're paying on the due date, do you have to worry about the grace period? The grace period, right, that's what the due date is. You got that grace period. You don't have to pay on the statement date if you don't want to. You got to look at the finances and see which one is better for you. And so what we want to do, and this is our goal, all right, we want to make sure that we're paying on a date that eliminates as much interest as possible. Now, if that's not possible, right, that's okay. But if you can do this, right, because that's $9 you're not going to be charged, right, and pay right here, that's good. If you can do this and pay right here, that's good. You only get charged $3 in interest. But if you can do this, pay on a statement date, well, that's even better, all right? So I just wanted to give you an illustration of what that average daily interest is. That's each day $3, right, if you're at that $5,000 balance. Please, let's go to the next strategy. All right, strategy number 4, and you probably already know what it is. Reinvest the money saved, right? We're going to give you an illustration of what we're talking about here. Instead of spending the money you save, reinvest it, right, to generate more income. Now, let me show you what I mean. I want you to take a look at these three numbers for a few seconds, and I want you to tell me what they all have in common. Let's go. $25,000, $10,000, and $5,000. They have more in common than you think, okay? This is the amount that is within some people's IRA, that is within some people's line of credit, that is within their bank account, doing nothing. And worst case scenario, losing money. What you don't want to do is you don't want to have your numbers look like this, because they're not going anywhere. And when you're not going anywhere, you're going down because of inflation. And so reinvesting is one of the best things that you could ever do. Whatever you reinvest in, whether it's in yourself, which is the best investment, whether it's in stocks, in paper assets, whatever it is, crypto, right? The bottom line is there are no bad investments, just uninformed investors. Because at the end of the day, everybody's making money on something because they are informed about it. And so what we want to do is we want to reinvest. And if you need help with that area, please let us know. Let's hop into strategy number 5, which is regularly review and adjust your strategy. I'm so glad we got a tool for this so that we don't need to worry about it, right? So as your financial situation changes, so should your velocity banking strategy. What we want to do now is we want to show you what happens when we have that review right in place. So it's basically just tracking expenses. So let's say you have the groceries that you need to take care of, you have the education, the tuition that you need to take care of. All it entails is you looking at that balance sheet, looking at those that have a balance sheet, looking at your situation and assessing it correctly. That's it, right? Calling a spade, calling whatever those numbers are, what they are. Let's not try to make it anything different. But let's just call it what it is. Man, I need to cut this gym membership out because I'm not using it, right? That's a destructive expense. Let's get rid of that. Let's put it into something else that can build wealth versus tear it down, all right? That's all that takes care of that. Now, if you need help with that, we do have a tool so you don't need to review like old school, like it's 1830, right? Or anything like that. We do have tools for that. This is the 21st century and that's where we live, all right? Folks, that's it. 5 advanced velocity banking strategies to pay off or eliminate your debt faster. Remember, the key to financial freedom. It's understanding and effectively using strategies just like this one. Now, if you found this video helpful, give it a thumbs up and share with others who you think might benefit. Now, maybe you don't think they'll benefit. Share it with them anyway. All right. Stay tuned for our next video where we're going to dive deeper into each of these strategies. Until then, let's keep aiming for financial freedom. God bless and have a great night.